Welcome to the Cherry Beckert Tax Beat, a conversation about tax that matters.
Welcome to this edition of the Cherry Beckert Tax Beat podcast. Today we are covering the latest news and guidance regarding research and development tax credits. Innovation has always been at the heart of the American economy, but with the COVID pandemic and companies coming out of the pandemic, innovation is pervasive. I mean, even more now than it's ever been. This is where R&D tax credits come in. At the root of this issue is looking at technical engineering, scientific, computer science, all those type of things coming in play into the ability for companies to get lucrative tax credits, the R&D tax credits. Recently, the IRS has issued new guidance to help it review R&D credit claims made on amended tax returns. It's created a little bit of a stir in the industry. But we'll talk about that and some other related topics. So joining us today in this conversation are partners from the Cherry Beckert Tax Credits and Incentives Advisory Team. Marty.
Thanks, Brooks. Yeah, I'm Marty Kierman. Happy to be here today. I'm a managing principal and leader of our Tax Credits and Incentives Advisory Group, and based out of Tysons, Virginia.
Ron.
So I'm Ron Wainwright. I'm a tax partner in the Tax Credit and Incentives Advisory Group out of Raleigh, North Carolina.
And Dan.
Thanks, Brooks. This is Dan Mennel. I am a tax partner in the San Jose office here in the heart of research and development land.
All right, welcome, gentlemen. And as always, joining me is Sarah McGregor from Greenville, South Carolina. And I'm Brooks Nelson. I'm a partner from Richmond, Virginia. So Sarah McGregor, how's life treating you?
Life is good, Brooks, as usual. Lots of new clients are coming in the door, and we're hitting into the shoulder season of tax season, and it's pretty exciting. We've got all our new hires are busy, our interns are busy, all our partners are busy, and it's a good day to be in the tax world.
Wow, I just not even sure I know how to respond to that. But anyway,
with a big grin and a smile. That's the way it works.
Yeah. All right. So let's pivot over to the R&D conversation. Since 1981 or approximately thereof, the tax credit for increasing research activities, or R&D credit, has been a vehicle for the federal government and many states to incentivize companies to go out and make these investments. They use the tax dollars, the public money, to help carry our economy forward with innovation. I truly think that's been at the heart of making the American economy one of the greatest economies in the history of mankind. And you could argue there's some capitalism aspect of it too, but certainly this push for innovation has been at the heart of so much of what has pushed our economy forward and kept it strong. All right. As you may expect, however, when the government gives out rewards, there's always people that are going to try to take advantage. They're going to be, the majority of people are always going to try to do the right thing, I believe. But regardless, we have a relatively self-policing tax reporting system, and the IRS needs to come in and provide appropriate oversight. So, the recent IRS guidance is one of the main topics for today. But we'll also, so again, that'll be a big part of it. And we're also going to talk on some other legislative updates, or at least legislative activity. All right, so that's my grand intro. So let's start out with you, Marty. Why don't you give us a better overview of the mechanics, the nuts and bolts of the R&D tax credit? What is it? How can you qualify for it?
Absolutely. Thanks, Brooks. So keep in mind that the R&D credit is a dollar for dollar credit against income tax liabilities, and it's available to companies that perform R&D in the U.S. And we'll get to the definition of R&D for tax purposes. It's an incremental credit, meaning that the amount of a company's qualified wages, supply costs, and contract research costs that are credit eligible are based on what the company's similar QREs were, qualified research expenses were, over at least the prior 3-year period. And there are also special rules for startup companies that don't yet have a tax liability to convert these income tax credits into payroll tax credits. But in general, what is R&D for our purposes here? So R&D, as defined for tax purposes, is an activity performed in the U.S. devoted to, one, the development of a new or improved product, process, or design. Two, where the activity is technological in nature, meaning it's utilizing engineering, physical sciences, computer science, or biological sciences. Three, where there's technical uncertainty at the outset of the activity specific to the capability, method, or appropriateness of the design. And four, where there's a process of experimentation, essentially the time spent by employees and contractors addressing the technical uncertainties that I mentioned, specifically testing, whiteboarding, trial and error, consideration of alternatives. That's defined as a process of experimentation. So we're always focused on new or improved products or processes or designs. You see it in manufacturing, you see it in software development, you see it in almost any industry where the intent is to develop something new or improved, and you're doing it with, some real scientific or engineering background.
That's great. So Ron, you participate in several industry groups. You play some key roles in some leading industry groups. Can you tell us how important is this credit to some of those large manufacturers and industrial companies?
Thanks, Sarah. So yes, I mean, it's critical. As Brooks commented, one could argue very successfully that since 1981, it has driven the innovation around products and processes in our country to make us the innovators of the world. When you look across the United States, and though the R&D credit is somewhat industry agnostic, we're fortunate to sit on the board of directors of the National Association of Manufacturers, as well as on the board and the leadership team for the R&D Credit Coalition. So if you were to look back specifically to the 2018 year, $20 billion of credit was claimed dollar for dollar offset to minimize taxpayers' tax liability. That's at the federal level. That does not include the 45 plus states that also have an R&D credit that adopted since 1981. Of that amount, the Association for Manufacturers, both in the Advanced Manufacturing Institute as well as the National Association of Manufacturers, estimate that 70% of that $20 billion credit amount that was claimed was done in the industrial space. And when you think about what we're experiencing as a country with supply chain elasticity and some of the other challenges that COVID has brought to us, the Advanced Manufacturing Institute released a survey that indicated 72% of all industrial companies that represent approximately 70% of that R&D credit amount were changing their product, their processes, their digitalization to make their manufacturing facilities more lean, specifically given what we've seen in supply chain elasticity. And we'll talk a little bit about that later in the podcast.
That's great, Dan. So Ron has been talking about large industrial clients, but what about the middle market clients that we serve? Are we seeing a resilience or an opportunity to claim and take this credit?
Yes, I think to Ron's point, our client base reflects the macro trends that we're seeing with the large volume of activity in manufacturing clients. In general, we are seeing an increase in qualifying costs year over year within our middle market client base. Some industries did see a slowdown in 2020 and early 2021 due to the COVID impact. However, as a counterpoint, some companies, many in manufacturing, pivoted to develop new products and processes specific to the market demands of COVID, such as PPE equipment and outside of manufacturing in medical labs assisting with COVID testing. So we're seeing definitely an increase in demand and a lot of companies recovering quickly from COVID and putting money to work and trying to take advantage of the credits that are out there.
Okay, so I think we kind of covered the big picture of what's going on in the R&D world right now. So let's focus in on this latest IRS guidance. So Marty, what exactly is the IRS asking for? Who does this impact? What is required? What does it mean?
Okay, good question. And it's going to affect a lot of taxpayers, but maybe not as many as we thought. Specifically right now, and beginning January 10th, new rules came into place requiring any taxpayer that was making an amended claim for refund for an R&D credit to file a disclosure statement. The disclosure statement has to contain 5 things. Number one, it has to identify what the business components were on which qualified research took place. Essentially, you need to clearly list the projects or initiatives on which R&D took place. Second, the taxpayer has to list the research activities that took place on the business components. Now, you don't have to go to the detail of defining how these activities met the 4-part test, but they are looking for something a little higher level to indicate exactly what type of research took place. Number 3, you have to list the individuals that performed all the research on the business components. And that includes both employees and contractors. Originally, when this first was released to us, or when the IRS made us aware of this in a chief counsel memo back in October, the requirement was to list the last and first name of all the individuals. They have clarified that they will also accept the title and position of the person or persons engaged in the research by business component as well. Number 4, all information each individual sought to discover by business component has to be listed. What does that really mean? The IRS is looking for a list, table, or a narrative providing this information specific to what the goals of the project were and what they were attempting to do. We did have some discussions with the IRS about this early, and they confirmed that that was what they're looking for. Finally, they're looking for the costs by business component. Specifically, they want to know the employee wages, expenses, and the employee wages, the supply expenses, and the contract research expenses, again listed by project or business component. So that's what they're looking for. That's the disclosure requirement. And it's something that if you did an adequate job looking at your research activities, it shouldn't be overly burdensome to do, but it is a formula that you're going to need to follow in order for the IRS to accept your claim. And so, what does that
Marty,
mean?
is this for every return? So even our 2021 returns, we're going to have to do this?
It is not, and that's the benefit of it here. So it really is specific to amended claims for refund. So for example, if a company in 2021 had never claimed a research credit before, they do, per statute, at least have the opportunity to go back 3 years and do that. So to the extent they file an amended claim for refund, the 2018, 19, and 20 returns, they're going to have to include this disclosure on it. And those rules became effective on January 10th. Now, if they fail to do that over the course of this year, they have a 45-day opportunity to perfect the claim. And that's 15 days more than the IRS originally thought they were going to give. So it was originally going to be 30 days when they first let us know about these rules in the chief counsel memo last year. But it is something specific to amended returns. Companies that have been claiming the research credit year over year, this really isn't anything more than some additional information from the IRS in terms of what they want to see.
All right, so Dan, I want to follow up on a couple comments Marty just made there. The first one is not so burdensome. So, I hope most CPA firms are like us and are doing very quality jobs when they go out and do an R&D project for a client, and we have quality study. But so just provide us your commentary on what are we doing, or a good CPA firm doing when they go out and do a study versus what the IRS is asking us to provide on an amended claim, and how much of a burden / inconvenience is this really going to be?
Thanks, Brooks. Yeah, I'll reiterate some of Marty's points here, but we don't view this as a burden in the sense that it's not impacting negatively the way we do our work as a firm. Some commentators have described this as a burden, but again, we view this as an opportunity to distinguish the claims of our clients from those where robust assessment of the QRE, the qualified research activities, did not take place. In our recent discussions with IRS leadership who created this guidance, the number of refund claims had risen dramatically, and so they needed a tool or mechanism to determine that adequate documentation was taking place. And while the disclosure in and of itself is not adequate documentation, or it does not require everything that should be in place. It is an indication to the IRS that the taxpayer assessed the nature of the research activities, and that it's likely that adequate documentation has been captured. And again, just to reiterate some of the points that Marty made, keep in mind most large companies with a tax liability are already claiming the R&D credit annually, so this should have no effect on them. And additionally, for startup companies that are C Corps that are coming out of NOLs, there's the ability to claim the R&D credits generated in a prior year on a currently filed return with just an update to the NOL carry forward schedule. So again, we don't view this as particularly burdensome, but if you aren't doing these things that are generally part of what we do on an R&D study, it may be burdensome for others.
Okay, so just to make sure I understand what you're saying, in general, a quality study would already have the information the IRS is asking for here, and we would just generally view this as a recap of data that we've already pulled together. Just one follow-up question, which I know is going to be on many of our listeners' minds. Does this increase the chance for an audit? Or is the IRS going to be able to pick off information in here that will trigger something that otherwise wouldn't have been triggered?
Yeah, Brooks, I think you summarized it well. A quality study already has all these things in place, and it generally should not raise risk for any of the clients that are being well served by quality firms like ours doing a thorough job in R&D claims. So it does not pose a risk to our clients for any additional audit risk, but if you are having a study that doesn't do the quality job, perhaps it will.
Right. And perhaps that will be one of the main takeaways from this podcast, I imagine. All right, so let's flip over to some other stuff here. Ron, I guess we went back. This is with TCJA Act, where we got slipped in a provision that seemed like it was a little last minute under the cover of the night, where they put in a requirement to recapitalize R&D expenses out there in the future, and the future is upon us. But anyway, can you recap kind of what happened and where we are with the capitalization of the R&D expense?
Sure, Brooks. So as you highlighted, within the Tax Cuts Jobs Act of 2017 that was passed under prior President Trump, there was a provision that required, effective January 1 of 22, that qualified research expenses underneath a provision 174 would be required to be capitalized effective January 1, 22, as opposed to what is currently in 21 or through 21 and has been ever since Section 41 and 174 were placed into the Internal Revenue Code, that qualified research expenses were deductible. However, in capitalizing those, it puts a significant pressure on taxpayers, because then you'll be amortizing your research and experimentation expenses over a 5-year period or potentially over a 15-year period. There was significant concern that was raised in the latter part of last year and actually contained within the Build Back Better potential piece of tax legislation that was basically on December 19th in 20 not able to make it through the Senate. There was language in there which basically would defer that capitalization down to January 1 of 26. So in essence, a 4-year deferral. Just to give a sense of how important this is there's a couple pieces that have come out just this past week and this week. So you saw a number of defense contractors push Congress significantly to extend the amortization requirement effective January 1 to 22 to January 1 of 26. And they estimated that their cost attributable to this provision would be literally in the $100 billion. And so when you see large government contractors where we know that they are specifically in Department of Defense taking significant R&D credit, a Lockheed Martin was highlighted in the example or the statements that were made. But I think there is cautious optimism. So we would expect, subject to potential legislation, that provision will be corrected, and that provision would be corrected in 2023 or 2022, and retroactively set to January 1 of 2022.
Great. So a chance still that this capitalization requirement can be pushed off if we can get the right legislative vehicle through Congress to make that happen. Dan, what are you seeing as trends in R&D credits? Startup clients or other areas where you're really seeing R&D as a taking off?
Yeah, I would say the biggest trends that we're continuing to see in general, much more SaaS companies popping up. I think this is a trend overall for the industry, for technology companies to be SaaS-based companies. That presents its own sort of unique things that we have to investigate. More understanding that the credit exists, so more clients are interested. They're hearing through industry groups such as Ron described in manufacturing, through articles and periodicals that we produce, that the credit might apply to them. Many companies did not know about the payroll tax offset. And I would say more companies, what we're finding, are using technology such as time tracking, which can be utilized to establish qualifying activities. This can really help us streamline how we qualify, the qualifying nature of R&D occurring. And many manufacturing companies don't realize that what aspects of their business may qualify. It's just not people, like in white lab coats or just R&D expenses on a financial statement. You really have to roll up your sleeves and dig in to understand where R&D occurs, particularly in that industry, which is, Ron indicated in the early statistics, is a huge portion of where R&D credit claims exist or opportunities exist.
So I like, Dan, that you mentioned that I've been filling out timesheets to record my time and activity in this profession since I started sometime in the last century, and it's good to know that's a trend that where it's being pushed out to new companies.
You want that pain to be shared.
That's right. That's right. Others should know my pain.
All right, let's just follow up a little bit on that last topic. So, Dan talked about kind of the current trends. Marty, look at your crystal ball. What does the future of R&D credit look like to you over the next 3 to 5 years, let's say?
We're fortunate in that both our business model and the credit is premised on the inherent innovation in the economy, and that's not going away. And so along with that comes the opportunity to claim research credits. I like it when the IRS provides us guidance. As I mentioned, it just allows us to meet their needs, and it gives us a roadmap in terms of how we should be looking at things. So I as we go forward, I think there's more knowledge of the credit, so there'll be more companies interested in taking it, but there's also more companies. And so they're going to be new to the economy, and it's going to be an opportunity for them. I think it's great that the IRS put into place special rules a number of years ago for startup companies to use these credits to offset them against payroll tax. And as a matter, on a different note, over the last 2 years, we've worked with so many companies that had the opportunity to claim the employee retention credit. There's a interplay there with the R&D credit, where we're working with companies there to make sure that both they're not double counting, meaning they're not including wages in the R&D credit that they took for ERC, but we still need to track those attributes in years going forward. So we can do a lot for our clients by identifying R&D, ERC opportunities, tracking the R&D attributes. It's an optimistic time to be in this industry, and I've been in it for 20 years, and it seems like there's always more and more research credit claims going in every year, and more taxpayers with whom we can work.
All right, that is a good prognosis for sure. All right, so let's wrap up with some final comments. Ron, what you got to say?
Well, I'll echo Marty's comment. We actually like when the IRS promulgates guidance specifically from a research and experimentation perspective, because it gives taxpayers another opportunity to really study their business processes, their products, or their technology. Inherent in our GDP is clearly we're the innovators of the world. However, there's also another key in this, and I mentioned the supply chain. So when you think about what's happening in the amortization, is that it's estimated that if we don't retroactively apply the current expense, that literally would cost a taxpayer or taxpayers claiming the R&D credit about $8 billion just in the first quarter of obviously 2022. There's also a security challenge here to the country. And a piece of legislation was introduced just last week in the House, which is referred to as the American Competes Act. And it really deals with the supply chain as well as it deals with the research and development credit. Because if you were to compare us specifically against China's R&D credit, our current R&D credit is about 11 times less than theirs are when you think about this federal subsidy. So I'm very pro on Congress, as well as the R&D credit continuing to be expanded, as well as the ability for continued taxpayers to take advantage of this critical piece of tax legislation, which will continue to drive innovation in our country. Small little companies in the defense industry, as I mentioned, Lockheed Martin and Northrop Grumman, Boeing, as well as small little companies that were created in garages like Microsoft and Apple. Some of these really cutting edge companies that have been created over the last 15 or 20 years since the credit's been in the statute since 1981. So very optimistic. Obviously, it'll make its way through Congress at the appropriate time, but R&D is alive and well in my assessment as we sit on a number of the national committees, as Sarah highlighted.
All right. Thank you, Ron. How about you, Dan?
Yeah, I think just to reiterate quickly some of the points that Ron raised, the pandemic really pointed out to supply chain issues, particularly in the semiconductor industry. And I think we're going to see a cascading effect for the positive of R&D investment in the tune of billions of dollars. And many other industries that feed into that industry are going to be impacted, and we're here to help. So we look forward to that.
Marty.
I agree with what you say, Dan said, Ron said, and what Sarah says. I'm always in agreement with my partners here, but it's a good time to be in this industry, and we're just happy to be able to spread the word here. So thank you.
All right, Sarah, any words of wisdom?
The only thing I would add to this discussion, it sounds like the IRS has stepped up their view and are tired of getting weak claims in for refund claims and are asking for data that should be easily put together, as you guys said, if you have a quality study. So I'm all about having a good, robust tax system that is fair for everyone. And I think this is a move in that right direction to make sure that the playing field is level.
I really think this is the IRS asking the taxpayer for help. And I think the taxpayer is, with respect to our clients, we're more than willing to do that because we want to get these things reviewed properly.
I agree. And then I'll just end on like this kind of overarching message. If you haven't really taken a serious look at your company and its activities for an R&D credit, it's probably time to do so. Back to this comment Dan made earlier, it doesn't have to be work done by people wearing white lab coats and protective glasses, so to speak. So, and we got some great partners leading the great teams here to do these quality studies. So now's the time. Okay, I think that does it for today's podcast. Thank you for listening in on our discussion on the latest news for R&D tax credits. Quick disclaimer that we are not providing tax advice on this podcast. Please consult with your tax advisor hopefully at Cherry Beckert, with your specific tax issues, or to discuss information from today's podcast. Check out the firm's website at cbh.com for the latest guidance and materials on this and other tax and business topics. That's it for today. Please like, share, and subscribe. Thank you, Marty, Ron, and Dan, and Sarah, as always. And thank you, our listeners, for spending your time with us. We truly appreciate it. Let's call it a day and go forth in peace.